Two Nobel Prize winners. The creators of the Black-Scholes formula were it was Myron Scholes, Fisher Black, and Robert C. Merton. And it's called Black-Scholes, but everyone recognizes that Bob Merton made indispensable contributions mathematically, and he shared the Nobel Prize. To their credit, by the way, when those guys won the Nobel Prize in '97, Fisher Black had passed away, but Bob and Myron took the money and split it three ways and gave 1/3 to Fisher's widow, which was a very classy thing to do. So that was and well deserved, of course. But so we had two Nobelists, but the average IQ around the place was like 165 or something. It was crazy. You should always aspire to be the dumbest guy in the room, and I actually achieved that on a number of occasions. We had MIT professors. David Mullins was former vice chairman of the Fed, the youngest full professor in the history of Harvard University, and lesser known names, but well known in the industry. Greg Hawkins, we call him the Hawk. So there was no shortage of talent. But
so John Goodfriend from Solly was there as well.
He was not. John Goodfriend was the boss at Solly when these guys coalesced as the in-house arbitrage team.
Okay.
I just did not to digress too much, but that blew up in a scandal. People went to jail in 1991 because Solomon, it was not our guys, it was Paul Moser lied to the Treasury. He was trying to corner the market in two-year notes. It was like right out of like 1869. It was the gold squeeze, but he was trying to corner the market in two-year notes, and there was a ceiling on how much any dealer could own. I think it was 25 or 30% of the issue. But he lied. He said, well, we're bidding for customers, which was okay. And he bought like 70% of the issue, but he lied about the fact that it was for the house account. He was saying it was for customers. And of course, he came close to cornering the market, but it was found out. He went to jail. But that caused the board to fire everybody. John Merriweather was not fired, but he chose to resign in the face of, he was not implicated, but it was kind of like he was vice chairman, so it was hard for him not to be affected. But then they left as a group and formed Long-Term Capital Management. So we moved to Greenwich, Connecticut. So we were the northern version, reincarnation of the Solomon Arbitrage Group, of which Goodfriend had been the boss. Right. I met Goodfriend later, spent a lot of time with him. Interesting guy. But
how so?
What they missed.
How so?
What he in a very well dressed, $3,000 suit and tie kind of way. He was very vulgar. But it was like second nature to him. He wasn't like a guy gratuitously throwing around the F word. It was just the way he talked. And but he was a real Wall Streeter, very wealthy and all that. But he was every bit as vulgar in speech as I had been led to believe. So I was like, okay, you're the real deal. Okay, so you got a whole bunch of 165 IQs and two Nobel Prize winners and all the modeling technological capability you could possibly. What did they get wrong? They had an a priori assumption that when spreads widened, when I say spreads, two instruments, off-the-run treasuries versus on-the-run treasuries, or on-the-run treasuries versus treasury futures. And you could apply this to anything, Japanese stocks, French stocks, and we did. If they were essentially the same, and should be priced the same and would end up the same if held to maturity, that you want to own that spread and just wait patiently for the spread to converge and then close it out and take the profits. And because the spreads tended to be razor thin, you could apply high leverage. Now, isn't leverage dangerous? Yes, it is. But if you have a sure thing, if you know it's going to converge, and in fact, they were going to converge, you could leverage it comfortably and you were just going to make more money. So that's the idea. So when the spreads widened and you lost a little money on the trade, they would kind of say, well, a good thing just got better. Like the old school traders would say, it's nature's way of telling you you're wrong and get out of the trade. But long-term capital is like, wait, good thing just got better, buy more. Widens, hey, buy more. This thing's getting richer all the time. But what's happening, of course, is that you're walking into a trap, because at the end of the day, in a global liquidity crisis, the spreads go like this. And then it's not a cliche, it's true. Markets can remain irrational longer than you can remain solvent. And that was what they missed. We had $4 billion in cash. and we leveraged through futures and all that. And we had $1 billion line of credit. We had repo facilities everywhere. We were tough negotiators when it came to margin calls and all that stuff. And as I say, our accounting was so good, we knew how much we lost to the penny. This was never a case of mismarking or, gee, the market's going to get, what's going on? We knew exactly what was going on. That was kind of the scary part. It was like we did know exactly what was going on. But things like that have two stages. Stage one is the market's moving against you, and instead of getting out early, these guys doubled down in what's called a martingale strategy, in the firm belief that it would converge, which it would, but too late for them. But then there comes a time when the word gets out that you're the biggest victim, at which point you're the marlin and the old man in the sea. The sharks come at you. The street doesn't care about the market anymore. They systematically trade against you, and they will not stop until there's nothing left but the bill and the tail and the skeleton, that you're picked clean. So August was, the world's going against us. We're losing a lot of money. But September 1998 was, no, the world is now systematically trading against us. There's no hope. There's no way out. And then when we called the Fed, because we knew more about that anyone, of course, we absolutely did not expect a bailout, and we were not asking for a bailout. We said, there's no way the Fed's going to bail out a hedge fund. I mean, come on. But we just being good corporate citizens, we're like, man, this is a problem. We ought to let them know before it takes down the world, because that was in the process of happening. And I'll never forget Peter Fisher, who was head of the open market desk at the time, and Dino Costa's right hand, and Gary Gensler, who was Assistant Secretary of the Treasury. Now he's the head of the SEC. These guys never go away. Gary and Dino and Peter came up to Greenwich and sat with JM and me for 6 or 7 hours. And we had computers, of course, but we had printouts of the positions. We just went page by page. And at the end of this, hours-long presentation, Peter Fisher, his face was white, and he said, blanched, and he said, we knew you guys were going to take down the bond market. We didn't know you were going to take down the stock market, because we had $15 billion of stock positions. We were the largest risk arbitrager on the street. Nobody knew that. Like, hey, you guys are bond guys. What are you doing in the stock market? We were in every deal. If you go back and look, Lockheed Martin, Lockheed Boeing, Citibank Travelers, MCI WorldCom. You go back and look at the deals of the time. We were in every one, up to 4.9%, because you don't have to disclose until you hit 5. So we would cap ourselves out at 4.9. Nobody knew this. And it's like, you guys are going to take down every market in the world. And we would have. So that's when they went back and had breakfast with John Corzine was the head of Goldman Sachs at the time, and Sandy Warner at JP Morgan, and David Kamansky was head of Merrill Lynch, and they sat down and cooked up the bailout. Then there was like no sleep for 5 days. But my point is, the best description of a financial crisis I've ever heard is everybody wants her money back. Like, that's the easiest way to understand it. It's not like, this asset's bad, I'm out of this, I'm going into that, or I'm rotating out of this sector, getting into that sector, or no, it's like everybody wants his or her money back now. And so all asset classes behave the same way. They all go down, and all the spreads widen, and they keep widening until either there's a sequential financial failure, which was happening in 2008, by the way, just to jump ahead to that, or you shut every market in the world. We came within hours of closing every market in the world in 1998. We got the $4 billion in. There's a press release. Things calmed down, not right away, but we still lost more money after that. After Wall Street took us over, we lost another $500 million. But Alan Greenspan cut rates twice in a matter of days, and then things calmed down and kind of went back to normal. Actually, Wall Street made money on that deal. That wasn't their intention. They were trying to save their own skins. But a year later, it was liquidated, and they took their money back with a small profit. But at the time when you're in it, there's no rationality, there's no rotation, there's no safe harbor. It's like everything's going down. And we're getting close to that today.